Morning, everybody. It's good to see so many people here, and thank you all for coming. I'm Jerry Coakley from the University of Essex, and together with Vanya here, who sits in the front row here from Essex also, we head up the local economic growth research stream of the centre. My specialist area is financing, corporate finance and the financing of SMEs. And this morning I'll talk a bit about the financing of SMEs, but focusing particularly on crowdfunding, because that's one of the recent developments, a very exciting development, and also an area where the UK is a world leader, different aspects of crowdfunding. And it's the good thing about crowdfunding is it has a wide reach. It reaches across the whole of the UK, so all local authorities can make their small businesses, local businesses aware of these opportunities for funding in the future. Okay? So this morning I'm going to talk a little bit about the background, then talk a bit about crowdfunding in general, the concept of crowdfunding, and then finally I'll talk about equity crowdfunding in the UK. But mainly I'm not going to focus so much on research as on some of the engagement we've had with crowdfunding platforms. Yeah. So there are two traditional sources of SME finance. One is debt. And of course, banks readily supply overdrafts to virtually all SMEs. Other sources are credit unions and credit cards. Yeah? And then the other source is equity. Yeah? So early stage startups often rely on friends and family, but also some business angels. And then later stage, venture capitalists may get involved, but of course, since the financial crisis, the supply of both VA and venture capital investment has been limited. Move on to the next slide. Banks just aren't able to understand small businesses. Headline from a recent article in the FT. Now, I'm not here to bank bash, on one hand, banks are very happy to supply small businesses, including unlisted small businesses, which we're focusing on, with overdraft facilities. But to grow, small businesses need longer-term finance, medium-term finance, and in this context, banks' lending technology doesn't work really because they want profit and loss accounts and cash flow statements over periods of up to 5 years. And small businesses, micro businesses and small businesses who, say, employ less than 50, typically are not required to produce profit and loss accounts. They only provide balance sheet information. Okay? And in this context, of course, then recently you've got challenger banks, new banks who are prepared to engage with new technology and in that respect access and evaluate and provide medium-term finance for small businesses. But much earlier, you had the idea of crowdfunding. Yeah? So I'll move on to crowdfunding. Now, a general definition of crowdfunding, it involves the financing of new projects, ideas, and businesses. So it's not just businesses. Using several characteristics of crowdfunding. It uses an internet-based platform. Typically, it's outside the traditional financial system. This is known as disintermediation. But increasingly, in recent years, there are links forming between what we call the traditional financial system and crowdfunding platforms. Potentially large number of investors or subscribers, and people have described this as the democratization of funding. And finally, at least in theory, it's not geographically constrained. Though our research reveals that for equity crowdfunding in particular, I think there is a geographic bias, because it's the most risky form of crowdfunding, and investors tend to invest locally rather than across the country. A quick typology of crowdfunding. So you have a basic distinction between non-financial compensation and for-profit crowdfunding. And within the non-financial compensation, you've got donation-based and reward-based crowdfunding. So the kinds of campaigns that Kickstarter typically funds. Even though Kickstarter does fund a wide variety of campaigns, including equity campaigns. But their main focus is donation-based or reward-based crowdfunding. And then on the other hand, you've got for-profit crowdfunding, where the platforms are commercial organizations. They operate for profit. And this can be divided then into a couple of different categories. You've got long-term crowd investing or equity crowdfunding. Then you've got crowd lending, often called peer-to-peer, at least in the UK, called peer-to-peer lending. And that tends to lend up in the medium term for maturities up to 5 years, 3 to 5 years typically. And then you've got very short term. This is a recent development, and to my knowledge, it's mainly in the UK this is developed. Yeah? There's a platform called Market Invoice, which provides this short-term invoice finance. It also provides accounting packages for small businesses. Yeah? So it's kind of an integrated service, as it were. Now, there's some discussion about what is indeed crowdfunding, and it's a widely used concept in USA and Europe. And equity crowdfunding is used in the UK, and typically when people refer to crowdfunding in the UK, they mean equity crowdfunding, because peer-to-peer lending is often used instead of crowd lending or debt crowdfunding. But peer-to-peer lending is still crowdfunding. Yeah? It's just that the providers don't like to associate it with crowdfunding because crowdfunding is much more risky. Equity crowdfunding is the riskiest one. So peer-to-peer lending is seen as a less risky form of funding. So it's known as the different names: marketplace lending in the US, peer-to-peer lending in the UK, crowd lending or debt crowdfunding in the continent. Now there's another concept as well called alternative finance, and that has 3 characteristics. Yeah, so it's wider than crowdfunding, at least from my perspective, because it includes challenger banks, these new challenger banks like Sterling, and foreign exchange platforms. It includes fintech, digital technologies, and machine learning and big data applied to various financial activities. And finally, you've got internet or web-based platforms. Yeah? So from my viewpoint, alternative finance is slightly wider than crowdfunding. Now, let me just talk you through the process. Suppose an SME needs funds. It applies to a crowdfunding platform or a peer-to-peer portal provider with a proposal. Then the platform evaluates the SME and the proposal. Yeah, they use big data to search all their previous credit history, for example. They have face-to-face meetings with management. They discuss their plans, etc., etc. Now, of course, you might think, why don't platforms just approve everybody? Well, it's a question of reputational capital. Yeah? Platforms have to do proper due diligence. So they have to try and decide, is this proposal or project feasible? Yeah? Is this likely to make profit? Will they be able to continue life? Yeah? And so to protect the reputational capital, they have to have tough criteria to allow companies to launch a campaign. And of course, if the proposal is approved, then the small company launches a campaign on the web, and then it has a particular time period within which to meet its target. In some cases, the target can be exceeded. The crowd invests their money, and it's an all-or-nothing system. Yeah? So if the company fails to reach their target, funds are returned to the investors, and the company doesn't get funded. But there are cases where a project can be oversubscribed, and the platform and the company can agree to what limit they will oversubscribe the project. Okay, so let's take a look at market share. Peer-to-peer lending to consumers developed in 2005. Zopa was the first crowdfunding platform or peer-to-peer lending platform. Was founded by members of Egg Bank. I'm not sure if anybody remembers Egg Bank. It was one of the first kind of alternative banks back in the early 2000s. And this had a 100% market share up to 2009, yes? So this is a diagram for the Cambridge Centre for Alternative Finance market share. And you can see up to 2010, the darkest blue shade here, that's peer-to-peer consumer lending predominated. Yeah? That was 100% of all all the crowdfunding up to 2010, and then from 2011 onwards, you find that this is the light one, this is peer-to-peer business lending, yeah? It's the lighter green, and that rapidly expanded from 2011, there it's up there, and then its share gets bigger and bigger, up to 2016, where it has exceeded, overtaken peer-to-peer consumer lending. Then the little one up here on top is invoice financing. That's grown quite rapidly. And then right on top, you've got equity crowdfunding, which in this context seems small, yeah, but it's actually quite important, yeah, because the sums raised in equity crowdfunding campaigns are quite large, yeah, compared to peer-to-peer lending. Yeah? So typically in a peer-to-peer business loan, the sums raised might be something like 100,000, yeah? Whilst in equity crowdfunding, the sums raised will be anything from 100,000 to 3 or 4 million pounds. Yeah, so we're talking about a much bigger scale of operations for equity crowdfunding. Now again, take a look. Forget the growth thing at the moment. Just focus on this. So again, up to 2010, you just had peer-to-peer consumer lending. Then it's only from 2014 really that crowdfunding has taken off with peer-to-peer consumer lending, business lending, and then on top equity crowdfunding, and up to here. So there's been really rapid growth in the last few years, and this growth has continued. So the data we have show that this growth has continued. I think it flattened out a bit in 2017, but again, 2018, growth seems to be on an upward trend again. Now, here are some spikes in growth, and of course, with low activity, you can get big spikes in growth, so I wouldn't take much notice of these spikes there. But notice here, even though there's been a dive in growth rate, it's still just almost close to 40%, yeah? That line there is close to 40%, yeah? So in sum, equity crowdfunding has expanded very, very rapidly. So now I'm going to turn to equity crowdfunding. And in the UK, there are 3 big equity crowdfunding platforms. Now, the crowdfunding platforms in the UK they're huge by international standards. Yeah? So Crowdcube, which was founded in Exeter, started in 2011 and has grown extremely rapidly. Seedrs was started in Oxford. And one of the notable things about Seedrs was all investors are protected. Yeah? They have a nominee account system where all investors, you can invest as little as £10. So both Crowdcube and Seedrs, you can invest as little as £10. On Seedrs, even if you invest £10, your rights are protected just as much as the bigger investors. Yeah? Your current rights, your voting rights, future rights if the company is taken over or if venture capitalists invest in the company, etc. And then finally, you've got Syndicate Room, which was founded in Cambridge. And this pioneered the idea of a lead investor. Yeah, the idea, Syndicate Room has a minimum contribution of £1,000. You need to be a high net worth individual to invest in Syndicate Room, and they have a business angel typically as a lead investor. They used to require a company to have at least 20% of funds before a campaign could go public. Now it's 40%, yeah? And both Crowdcube and Seedrs have also followed this, yeah? So they want 20% of the campaign pledged with a lead investor before the campaign goes public. And here's a breakdown. It's difficult to get breakdown of investment by industries, but here's one for Syndicate Room. And it's quite interesting in terms of the main areas they finance. So industry breakdown, over a third, 34% is invested in life sciences, 16% in software, 14% in web, and 10% hardware and technology. So basically, they are a very tech-oriented platform, yeah? And the sums they fund, the sums they raise are much bigger, yeah? So typically, Syndicate Room campaigns are from £500,000 upwards, lots of them in over £1 million, yeah? And it's been found that having a lead investor attracts lots of smaller investors, yeah, because they think the lead investor provides a certification effect, and then they all smaller investors then follow suit, and you do get some evidence of herding in the funding of campaigns. So equity crowdfunding in the UK, well, equity crowdfunding is pre-IPO equity, and is typically for seed and early stage startups, but more recently it's been used at growth stage, later stage startups. Yeah? It's the most risky of all, and many ventures fail. It's difficult to get exact data on the number of failures, but my rough figures I've seen suggest it might be something between 1/5 and a quarter of all campaigns fail. Though I've also noticed a trend that in recent years, more recent campaigns seem to exhibit a lower failure rate as platforms have become more adept at due diligence, because due diligence, that's checking the books of the SME who wants the equity raise, checking their proposal, etc., etc. Yeah? Now, the other thing about equity crowdfunding is your investment is illiquid for several years. Yeah, but that's changing. Yeah, so, whoops, Paul just told me. So I just mentioned here we've had several events. So at the center, the first is an engagement event with crowdfunding providers. We had representatives from Market Invoice and Syndicate Room, and then we had a conference this year in June with Professor Douglas Cumming from Ontario and speakers from Cedars and the Syndicate Room co-founder Tom Britton. SMEs typically are exempt from producing a prospectus. Yeah, this is under the EU prospectus directives because it's quite expensive to produce a prospectus, and also SMEs may have to reveal some sensitive IP information. Yeah? And there's a new prospectus regulation which came into force this summer, which raises the exemption limit up to €1 million for all states, but gives a option for it to be increased to £8 million. And I talked to platforms, and the BLG Centre submitted evidence to the Treasury Select Committee on SME Finance, and this is published on their website. And the main thing we showed was for equity crowdfunding, there's an increasing tendency for campaigns to get bigger. So the mean campaign amount is, for big campaigns, that's above $500,000, is 1.1 million, and the biggest one was 3.9 million, and this accounted for 26% of all campaigns in 2017 were bigger than £500,000. Yeah? So crowdfunding is growing very rapidly. It's the UK success rate, and lots of the other European Union member states are trying to follow Britain's lead in equity crowdfunding. The platforms are helping SMEs to invest and grow, and because they're tech companies, they're much more adept at understanding innovative firms and their proposals. And finally, they'll play a key role in the government's Industrial Strategy Challenge Fund for promoting areas such as quantum technologies, robotics, and, as Maria mentioned, artificial intelligence. Thank you.
Hello everyone, my name is Winifred Huang. I'm from University of Bath. My research interest is mainly on corporate finance in the beginning, and then recent years have the chance to work with Jerry, so also focus on SME, small, medium-sized enterprises. Then touch the crowdfunding, peer-to-peer lending, and fintech. Recently also have another working paper related to initial coin offerings. So all the idea is to looking at companies, no matter it's big or small, how they actually raise the funds, and then how they actually use these proceeds. So that's very important. And then further, we'll look at their capital structure. So for small medium enterprises, the very difficult part is how they actually make the financing decisions, whether they think a bank is the first resources to go, or nowadays there are a lot of technologies. So today we'll talk about peer-to-peer lending. And so this is particularly one of the paper also with Jerry. So we focus on peer-to-peer lending, and the data is mainly from one of the biggest leaders, Funding Circle, which is in UK based. So here give a little bit background because Jerry already gave very detailed about crowdfunding. So you can know that crowdfunding, apart from the platform, crowdfunding has been very early years that private equities, venture capitals, angelists. So basically, they are also these investors to support a small business. But now, related to the evolution of financial technology. So there are crowdfunding platforms which kind of become the bridge between investors and the businesses, small businesses. They are still a little bit intermediary between investors and business, but less restrict than you go to the bank. Going to the bank, they will ask you a lot of paperwork, and also will check whether you have filed your reports, your financial reports. So for small business, that's very difficult for them because they have no such knowledge. So therefore, the crowdfunding or cloud lending platforms becomes very popular to them. But before this peer-to-peer lending, from 2005, actually, there is a lot of small, growing UK-based banks, which we call challenging banks. This one, challenging banks. Today, we don't have time to talk about challenging banks, but challenging banks are also very interesting groups. There are now lots of them. I have a kind of a list which you might know, heard of that, but if you search, you will now. There are a lot of challenging banks in UK. So we have government-backed British Business Bank, Cambridge and the Counties Bank, Cash Plus, City of London Group, all sorts of these challenging banks. They provide the lending for the small business. The difference to peer-to-peer lending is these are not platforms, but they're also another resources for SMEs. And then you can see this one, cryptocurrencies. That's particularly for the technology-focused innovative groups, the ventures. They will use these cryptocurrencies to raise funds. So all these are very new resources. So peer-to-peer lending is part of the crowdfunding. Today we talk about peer-to-peer lending on the platform. So this is the same slides that Jerry has to give you the knowledge that we are talking about. I'm talking about this one, peer-to-peer loans here. So these are the three biggest one in the UK, but also UK is the main leading peer-to-peer lending platforms globally to influence Europe, USA, Canada as well. So Funding Circle, here need to update a little bit because I sent slides very early to Paul. So peer-to-peer lending, Funding Circle is the main leader, and it will lend to any small business from 6 months to 5 years. The second one will be peer-to-peer invoice. Market invoice will be the leader, but this is much small loan just for 1 year. And then Zopa is for consumer lending. So this is not mainly for the small business. So this is the same similar graph. You can see the orange bar here is for the peer-to-peer business. In 2016, we already have about 1 billion figures, 1.2 billion figures here. So later I will update you another new figure from Funding Circle. So SME, they apply funding, they want to open the account on Funding Circle. They are kind of a system they need to follow. First, they have to be in the business for 2 years. So it's not everyone they could do the account and then ask the crowd to give them the money. So Funding Circle will be this monitor to look at the credit and also check whether they have financial information. So first, the business has to run for 2 years at least, and also need to have a 1 year filed financial accounts. The loan type, if there is no any secured, but you can have a personal guarantee, you could borrow up to 350K. But if you have a secured properties or mortgage, you could borrow up to 1 million. And Funding Circle use the machine learning to evaluate each business credit risk. So it provides a ranking range from A+ to E to investors. So for risky investors, they would like to have a high return, and they could look at these different types. So once the loan is approved, there's advertisement on the website for about 2 weeks on the Funding Circle site. So it runs with all or nothing. So if there's an amount raised till, we say closer, but not to the amount needed, then it's failed. So it has to be based on you judge your profile and your project, your venture, how much you're going to ask for the investor. If you're not reaching to that level, then this raising will not be successful. Here is the updated information. So I think from 2018 November now, that Funding Circle already provides, let me have a look, 56. So it's doubled 56 small and medium enterprises business. It's quite a lot from 2010 to 2018. Now it's in December. And also, we have about 77K UK investors to invest this business through Funding Circle. And then also, this is up to 5.6 billion lent out, the total amount, the volume. So it's very important to our economy for our UK's growing. And here, why this research is important, not just for the research point of view, it's also very important that we now look at there are lots of growing small business. They not trying to grow to be listed companies, but they are trying to be stable. So it becomes very important that they are not going to be in the stock market, but they are going to be very established business, and then family business as well, and then continue. So in the past, there are not many studies look at peer-to-peer lending, because like Funding Circle, the first leader one, it's only started from 2010. So you could see the research here, like the first paper, Koch et al. One of the co-authors is also the speaker coming in June this year to give the speech. So his study is also outdated in 2009. At that time, there is no any digital crowdfunding platforms or crowd lending platforms talk about. So this is back at the time we could find the research papers about that. And our studies focus on listed SMEs. And also they are, most of the time they are private. They are not listed on the market. The difficult part to analyze whether this debt is very important in their business growing is that they don't have many years financial data. So even from the databases FAME, it's also not easy to find continuous years. So you could see many of our lending, or here, maybe it's next slide. Many of our sample period, the Funding Circles successfully supported the business is in 2014 and 2015. So it's just about 3-4 years ago. And here, P2P loans account for about 14% of UK lending in 2015. And now I believe these figures will even be more. So very important to our economy. So this paper, this research, that why we look at this particular peer-to-peer lending, because funding circle is under the regulation by FCA. So some of the funds is government-based funding. So it's also very supported to SME businesses as well. And then most of the loans, they are about just in the beginning of the maturity. About 2/3 of our sample, they still have 5 years. But this data is up to 2015. So now it's 2018. So they are about on the middle of the debt lending. So here just give a little bit our research outcomes focus. What we found is this peer-to-peer debt very important and very related to these SMEs' performance, their profit performance, and also related to tangible assets, but not find related to their growth. So that's why still question about this kind of SME business lending. They are not trying to borrow the money to grow the business. They are trying to borrow the money to stabilize the business, and then the performance is still going up. So here has some data information. Like these companies, SME, in our sample during this period, they are not very, very young or startups. The median age about 9 years. So they are kind of set up their business, and then they think, oh, to a certain level threshold, they need money to support their tangible assets. And also most of the leverage, you can see the leverage here, average leverage. So leverage, this one we calculate is the total loan, total debt, which is short-term and long-term debt over the total assets. So this leverage for the company is about 1/4. So it's not too low, but it's also not too high. And the maturity of this debt from P2P is about 4 and 3 years, but this is a data till 2015. So the sample, as mentioned before, raised lately in 2014 and 2015. So believe this number still growing very, very high now. So amount raised for all the SME, the average about 64,000 for the one of the business, average figure. And in 2016, it's up to 73K to support a small business. So this is just a graph for the distribution about the peer-to-peer debt maturity. So majority still, they borrowing the money up to 5 years and then pay the debt interest to the investors. So we have some hypotheses, but not trying to go to the detail. So just will highlight that. First, we want to highlight that this peer-to-peer debt through this online platform, it becomes very important factor to the company, even just a small business companies, their total leverage ratio. So that is what we found. So the government or regulators, investors, they should not take this as a small factor. This will come into influence each company's, small business companies, their balance account. So here just the regression that we show about 5% related to the company's leverage. So it's very important. And here we could see, as I mentioned, that this lending is related to tangibility, tangible assets, and also to their leverage, in the past, the leverage, but not really related to the growth And also not related to the caps here is the investment opportunity. So this business, they are in the very, established level. So if they need to grow, they need even another business plan or another big amount of money. So from our findings, this is not related to why they borrow the money. The second one is whether to issue the peer-to-peer debt if their leverage ratio could still reach to the optimal. So many companies, as we know that there is a pecking order theory or there is a trade-off theory, which is if there is an optimal level of the leverage, the firm can borrow. So whether they will reach that or they will just save, no, I'm not going to have a debt as many as possible. But now we find it out many, not just corporates, many small businesses as well. If they could reach to the level they could borrow, and they would do that. And here we find that peer-to-peer lending is one of the important factors for them to consider if they could borrow the money apart from the bank loans. So here just the empirical analysis to show that it's very strong results here. And so another level to consider is what's the important part to a company, if they need to raise the money. So the financial decision, very important. They should borrow the money, just pay the interest and the principal to the investor, or they should give up some ownership shares, which is the equity. So in finance, this is kind of pecking order theory. Which one is more important to the business? So corporate side have this kind of theory. Will turn to borrow the money from first internally. If you have enough cash flow, you will not go into bank, and then go into bank, and then will give up some shares. So we would like to see whether for this SME, if they have this new layer of these funding sources and how that affect into their pecking order. So here we find debt still important to this small business. Peer-to-peer level, we have tested against to the bank loan. Small business, they are still prefer to go to the bank. That is their first priority. And then if they have no choice, they will go into the peer-to-peer lending like our Funding Circle platform. Or the last resort, we are going to do the equity to give up some shares. So it follows this order. Even they are very difficult to go to bank, they will still choose the bank first over the peer-to-peer lending. One of the explanations that we think it might be because banks still provide very strong and robust credit check. So if this business consider in the future to be the IPO listed on the company, they will need this kind of strong background where this credit from. So that is one of the reasons. The second reason I think might be a lot of these industries, they not really the experts of the technology. So they may not think this is a very easy access platform to provide information. So even we say, Funding Circle platforms, you could try, but they may not trust the digital technology nowadays. So as you can see, these figures are very important. So it will help SMEs to choose. We now haven't got enough data to find out whether in the future the digital lending will be over a bank loan as the first resource. That will be the future explore area. So conclude that this is what we found, that small SME in UK, they are growing and they raise the money from peer-to-peer lending to reach their optimal leverage and related to their profitability and tangible assets mainly. So that would be all. Thank you.
Okay, so thank you very much for giving me the opportunity to present this paper. That is a research paper that we are carrying out at Essex with our PhD student, who is actually in the audience and will answer all the difficult questions later. So this basically, after 2 papers on crowdfunding and peer-to-peer lending, this paper looks at banks lending. So in particular, what we were interested in with this study is to look basically at the impact of financial literacy and awareness of government initiatives. And I'm going through, to be able to explain what we're doing, I'm going to give you first a background, then a little bit of literature, what has been done before, and how we believe we improve compared to that literature and what our findings are. Right, so first of all, the background is well known to all of you. So small and medium businesses have suffered massively with the crisis. Banks have been quite reluctant to lend post-crisis because of their own problems, and SMEs often can be quite opaque because of their financial data, that they don't have maybe sometimes the history behind them that is published like a firm that is listed in the stock market, say. And on the other hand, also because SMEs tend to often to be young and very innovative, so the business can be quite risky. So essentially, the government has reacted by offering SMEs several ways to apply for funding, various initiatives. Some were specifically for SMEs to pick up and try to exploit. Some others were for banks, okay, trying to, encourage them to lend more to SMEs, like funding schemes. So there was quite a lot that has been done from the government side. And for example, in 2009, the government launched this EFGS, that is the Enterprise Finance Guarantee Scheme, and that was the successors of a previous scheme, the Small Firm Loan Guarantee, specifically for those small firms that don't have enough collateral, that really don't have much of their accounts available, a lot of history in that respect. So really to try to help them. Now, just to give you an idea of the sort of numbers we're looking at and trends, I prepared this graph that looks at the period 2009 to 2018. So the most recent data available. These are data available with the British Business Bank website. And as you can see, over the past 5 years or so, there's not been, 5-6 years, there's not been much change in the level, on the number and the volume of loans that have been offered from this scheme. However, it peaked at the beginning of the period, but then sort of flattens out in the most recent years. Now, what do we do? What do we do in this paper? We try, in this piece of research, we try to really understand whether one factor affecting a lot the reasons why small and medium businesses don't get the financing they need is because they actually are discouraged to apply. Okay, and so the idea is that we know there is a demand. Potential demand, so they need financing, but they are actually discouraged from applying. And therefore, in this context, what we try to do is to try to understand whether the level of literacy of the owners, so so whether, for example, they have a finance degree or a finance A-levels, or they've taken an additional finance course in recent years, has any effect in understanding the reasons why they're so discouraged they don't actually apply. Now, this is important because in previous studies, discouragement has been estimated as being quite high. So we have looked at the literature, published papers, and in different countries, including the UK, and there are some data there estimated in previous studies of this discouragement. So firms that need financing and they actually don't apply. And as I'll say later, many of these studies find that had they applied, they would have probably got the credit they needed. And that's why it's even more important to try to study this particular topic. So for us, in terms of literature, trying to see what has been done before and how we differentiate from that literature, I can say that there are a couple of recent studies that are published, and they look at the scale and trends of discouragement. And some of them have tried to understand the factors affecting this discouragement, and often these have been related to for example, the size of the firm or the ownership of the firm. Sometimes even the gender of the owner can be a factor. And the level of innovativeness, which goes very often with the fact that they are riskier, and therefore they try to find perhaps alternative funding. Because that's the other thing, that we are not, we are in a world now that the bank that the firm may say, okay, I don't go for the bank loan, I'd rather go for alternative finance. And so it's because anyway, I'm discouraged and I've been refused already once or something. That could be the way they think. And they are maybe unaware of a particular scheme that could help. The other thing I mentioned before, Cowling, for example, estimate, and co-authors estimate that 55%, over 55.5% of discouraged UK small and medium businesses would have been able to access bank credit had they successfully had they applied. Okay, so it's really important to look at that. So what do we do in this study? As I previously mentioned, we're looking at a relationship between awareness of government initiatives, financial literacy, so the level of financial knowledge of the owners, and discouragement. And in this equation, we try to see whether these relationships are affected in any way by the level of risk of the firm. So we have a variable that we can use in our model that allows us to identify two groups of firms based on some sort of external rating about the firm. And I'll show you a bit later about that. So the key hypotheses we aim to investigate are basically three. The first one is that we conjecture that small and medium businesses that are aware of government initiatives are less likely to be discouraged. Okay, so are less likely to be discouraged from applying for bank lending. The second one is that there is indeed a relationship between financial literate SMEs, so SMEs whose owners have a financial knowledge and the awareness of government initiatives. And finally, we expect different results for low-risk vs high-risk small businesses in this relationship, which is, in particular, low-risk and financially literate SMEs, in our view, will be less likely to be discouraged compared to the high-risk ones. What data do we use? Okay, so the government, that is this data that can be downloaded and is available. It's a lot of data. Which is from the SME Finance Monitor. And this is a survey that has been carried out over the past decade or so. And as you can see, we have a slightly different sample for overdraft and loans. As before, some of my colleagues have pointed out, there is a difference between, a big difference, especially in the UK, between overdrafts and loans, in the sense that the motives for asking for an overdraft can be substantially different from those behind the request of a loan. So basically, in this study, we distinguish between the two in all analysis. This data is based on telephone interviews, which have been made with 5,000 different UK small and medium businesses in each wave. So it's not a panel. It's not that we have the luxury of being able to follow the same firm responses changing over the years. So it's not always the same firm. These are generally randomly selected, and so we are not able, then they are completely anonymized, so we're not able to match this data with anything, and we cannot follow the same firm. Nonetheless, this information for us is very precious. We can use techniques that allow us to have some meaningful results despite this limitation. Now, the main topic of this survey is really to try to understand the experience of the firm in finding lending. So it asks the firm, have you been seeking for credit? Yes or no, and if in the past 12 months, and how much did you ask for, and were you successful? Did you know about this particular initiative, and so on? So there are all these sort of questions. And then, of course, there is all the demographic of the firm, so questions about the ownership, about the age, about the type of business. So we've got all that information as well. Now, in terms of methodology, because this hypothesis, I absolutely don't want to go into the details of this, but this methodology, we are confident that allows us to understand, to get meaningful results in this very specific setting where we have a firm who may or may not have a demand for credit. So we have the first the first situation. If the firm has a demand, then it may be discouraged or apply. So we've got these other two sets of decisions. And then if the firm applies, it can be successful or not, but can also, and then we can ask the firm if they were aware or not of the government initiatives, if they use them, and take into account of the literacy of the owners. So with this trivariate problem model, okay, which is a very advanced technique that we can use with the expertise of the young researchers, we can take into account of all these constraints. Now, the variables we use, so simultaneously, and to avoid problems that may arise, simultaneously we estimate the three equations, and we have as variables demand, discouragement, and awareness as dependent variables. Then we have our financial literacy. These dummy variables are yes or no variables, so they'll equal to 1 if it's a yes, that's equal to 0 if it's a no. And then we have the risk rating, the DNB risk rating, which is a dummy variable again, that identifies whether the firm is risky or not based on some thresholds, and all the various firm characteristics, owner-managed characteristics, bank relationships or products, and time. Okay, so let me just show you the results. I have extracted a couple of tables just to show you what the main results are. In our research paper, we got a big table, but several big tables actually, with a lot of results. But the key ones are here. So in this table, basically we test our first and second hypothesis. And as you can see here, the first 3 columns are about the overdraft sample, and the 4th to 6th columns are for the loan sample. Okay. Now, what we find is that, first of all, firms that are aware of government initiatives, and here we specifically, after various testing, decide to use awareness of a specific scheme, which is the Enterprise Funding Government Scheme. We find that those that are more aware of this scheme are actually less discouraged. So the SMEs in our sample that were more aware of this scheme were less discouraged, were more likely to apply for a bank loan. So this was a result that we found both for our loan sample and for our overdrafts. And the probability associated to this was higher actually for our loan sample, okay, which is where SMEs are more rationed, where they suffer the most, because they're more likely to get an overdraft, because they're usually smaller for shorter term. Then these are like line of credits, the firm may or may not use it, whereas loans are more longer term, they're usually bigger volumes, so clearly there is this is very important higher coefficient there in reducing discouragement. Remember, we are trying to understand whether this awareness reduces discouragement of firms from applying for bank loans and overdrafts. And the other thing is that we certainly find, these are simultaneous equations, that financial literacy is positively and significantly associated with awareness. So the more the owner is financially literate, the more is likely to be aware of these initiatives, and the more is likely to apply, so is less discouraged, which for us is an extremely important policy implication, because, I mean, there's a lot of people talking about financial literacy and the need for more financial literacy even in schools, starting from kids in secondary school, if not before. And I think the message is clear as far as entrepreneurship is concerned, and even in this specific context, we find that is an incredibly important factor. The second stage is to look at low versus high-risk borrowers, and I have 2 slides here only, and these are the last numbers and figures I'm putting up today. So this one is overdrafts, and the next one is for the loans. And I had too much of a crowded slide if I left everything in, so I decided to keep them separate. Now, in this particular slide, what I see is that the results don't really change for overdrafts when I distinguish between low-risk and high-risk SMEs. So there's not much difference, really. So here in the first part of this table, I have the low-risk borrowers, and here I have the high-risk borrowers, and the results are pretty much the same. Awareness is good in decreasing discouraged firms, and financial literacy is positively associated with awareness, which is the key things I'm looking at. When I look at loans, when we found these results for loans, the situation is slightly different. What we find here is that low risk, while for high risk borrowers there is no much difference compared to the previous results, for low risk borrowers, low and medium risk borrowers, I should say, because it includes also the average risk ones, we find that being more aware actually is positively associated with the discouragement, which was a bit intriguing and counterintuitive, but we thought that because this result of financial literacy is very negative and significant, so literacy decreases discouragement quite significantly, we believe that our interpretation of this result is basically that for low-risk borrowers, there is really a lot to gain from increasing the awareness via greater financial literacy. So more financial literacy programs, so making the entrepreneurs more aware, more on top of what is on offer as far as these programs are concerned. So, to conclude, Basically, what we do in this study is to look at the weight of discouragement, because we believe, and we saw in the literature, that is a key factor in explaining why the SMEs are so rationed by banks. It's not only their fault. We know banks have had their own problems and have been through a period of big credit crunch where they were very reluctant to lend. However, the fact that there is this fear of rejection, and that is significant in the UK market, has prompted us to look at what factors, in addition to those that had been already studied, could affect and what can be done, could affect the propensity of SMEs to apply and what can be done about it. So in these studies, effectively, our key findings suggest that raising the awareness of government initiatives that are targeted to SMEs is extremely important, and particularly for low-risk firms that seem to be those for which we get the strange, unusual result. It appears that carrying out programs to improve financial literacy could really help to bring credit-worthy, so low-risk, discouraged borrowers back to borrowing from banks. So that's it. Thank you very much for your attention.